Good morning, and thank you everyone for joining us today to talk Xerox. I'm Veronica Graff, and I cover special situations at LevFin Insights. So let's get into it. Xerox's credit story really seemed to change pretty dramatically over the last 6 months, and what was perceived, I think, earlier this year as a slow-moving balance sheet cleanup has evolved into this far more speculative situation now with weaker operating trends and liquidity tightening against a much heavier capital structure. S&P just last week cut the company to triple C, reflecting their expectations for steeper revenue erosion, tighter margins, and estimates for negative free cash flow this year. And I think the recent deterioration is compounded by sort of complicated long-term picture where a key source of free cash flow for the company, the HPS-backed finance receivables program, is set to wind down and come up against this $1.2 billion maturity wall in 28 and 29. So proceeds generated from those receivable sales have already shrunk significantly since the start of that program and are set to approach zero by 2027. We saw just now in Q3 earnings, management took down free cash flow guidance considerably for the year, with expectations previously of generating $250 million, now slashed by 40% to $150 million. So with that program tapering off, the concerns over negative free cash flow are definitely abundant. So this combination of weakening fundamentals, shrinking sources of liquidity, and limited secured headroom to issue more debt, which we'll address this morning during the webinar, has already landed the name on watch list in the distress space. More recently, the company's advisory engagements of Kirkland & Ellis and Lazard this fall, alongside secured creditor mobilization with Gibson Dunn, as LevFin Insights reported, is now fueling all sorts of debate and speculation around what kind of balance sheet solutions could be on the table. So to unpack it all, I'm joined by CreditSights Senior Tech Analyst Andy Williams, CreditSights Special Situations Analyst Nick Williams, Covenant Review's Head of U.S. High Yield Research Scott Josefsberg, and Covenant Review Analyst Kevin Grondahl. And then as we get through the dynamics here, if you have any questions, feel free to submit them in the Q&A box on the right, and we'll aim to leave some time at the end to address those. So with that, I'll hand it over to Nick to take us through the capital structure.
Thanks, Veronica. So yeah, we'll start by just walking through the capital structure shown in this slide, as it is fairly complex in this instance. We break Xerox's capital structure into 6 layers. These consist of ABL debt, the first lien term loan and notes, second lien debt consisting primarily of the 2L note, and then on the unsecured side, we have the Holdco notes issued in the Lexmark deal, which are the Holdco notes with 13% coupons. These newer Holdco notes have a better guarantor package than the pre-Lexmark Holdco notes. And then finally, we have Opco notes, which have no guarantees. And on the Holdco notes, we're going to get into this a little more on the next slide, but we should be clear that these notes are structurally senior to the Opco notes, somewhat counterintuitively. And as noted here, have a high yield covenant package as differentiated from the IG covenant package under the Opco notes. I think it's worth highlighting as well that the 1L, 2L notes, which are going to be highly topical as we walk through the covenant considerations for Xerox in a moment, were issued primarily in order to finance the Lexmark transaction, and were issued earlier this year when the company was already somewhat stressed. And so the terms and protections afforded to those secured notes generally reflect that kind of stressed market dynamic at the time of issuance. We show here an org chart for Xerox, really just as a pairing to the capital structure discussion we just walked through. But it's important to recognize that there are definitely some structural complexities to this story, specifically the foreign entities and foreign operations, which guarantee the 1L and 2L debt and certain of the Holdco bonds, don't guarantee the older Holdco issuances or the Opco notes. And there's obviously a similar dynamic with respect to the Lexmark entities. Lexmark has substantial foreign operations as well. And we believe that the value of those foreign operations, again, only benefits the 1L and 2L debt and certain of the Holdco bonds. Then domestic subs generally guarantee all of the outstanding debt other than the Opco notes. And finally, we highlight in this image a intercompany loan from Holdco down to Opco, which, we believe could be of additional value to Holdco notes in some circumstances. We published an analysis and recovery model last week, and that delves into a lot more detail on those types of considerations. And then I think we're going to throw to Scott quickly to Veronica to talk about maybe some more detail there.
Yeah, maybe Scott, you can walk us through how the guarantor packages differ across the Holdco and Opco notes.
Sure. Thanks, Nick. And, and thanks, Veronica. I wanted to take a second to focus on something that Nick said there, because I think it's worth it to understand what's going on in the structure here. Prior to the Lexmark financing, the 1L, 2L notes, and the 13% unsecured notes, a lot of folks like to think about this as a Holdco Opco structure, because you had bonds issued at Xerox Corporation and bonds issued at Xerox Holdings Corporation. But I think that to call it a Holdco Opco structure was confusing, because those words really mean the opposite of what they mean in this structure. It's really the Opco notes that are Holdco paper and the Holdco notes that are high yield style guaranteed debt. And so let me dig into that a little bit just to explain what I mean. So way back in the day, we had the long dated notes issued by Xerox Corporation, and that's what we call the IG style unsecured notes, or what Nick referred to as the Opco issuer notes. And although those bonds were closer to the assets, they had investment grade style covenants and no guarantees from any subsidiaries, which is fairly customary for an investment grade style bond. So then when Xerox did additional senior unsecured notes out of Xerox Holdings Company, and that's what we were referring to as the Holdco notes, the parent of Xerox Corporation, a lot of folks were referring to those as the Holdco notes. But those notes had a full IG covenant set and had guarantees from subsidiaries. They had a guarantee from Xerox Corporation, and they had a guarantee from Xerox Corporation subsidiary, Xerox Business Solutions. So it was actually the Opco notes that were structurally subordinated to the Holdco notes instead of vice versa. So that's why I like to refer to them as high yield style and IG style rather than Holdco and Opco. These, I think that thinking about them as Holdco and Opco can lead you down the wrong path. The difference between the high yield style notes is there were high yield style notes issued in connection with Lexmark, and those are the 13% step up notes. Those bonds have the same guarantees as the recent 1L, 2L financing, including some foreign credit support. The older legacy high yield style bonds did have domestic guarantees, and they also had a future guarantors covenant that said that any domestic subsidiaries that guarantee any other Xerox debt have to guarantee those high yield style notes. So that tells us that the state of play today is we have the old IG style long dated unguaranteed notes, and then we have two classes of guarantees on the high yield style notes. The Lexmark notes have domestic and foreign credit support, whereas the legacy high yield style notes issued out of Xerox Holdings has only domestic credit support, but it has domestic credit support from all the same domestic entities that. With that, why don't I throw it back to Veronica to keep the webinar rolling?
Yeah, let's just, I want to toss to Andy now to give us a sense, a little bit of the operational picture. We have the debt overview, capital structure, and Andy, maybe you can shed some light on the fundamentals.
Yeah, sure. Thanks. Let's dig into the fundamentals a bit more. So I've been covering Xerox in some capacity since 2017. And I think as recently as 2023, we actually thought there was a pretty constructive narrative of, relatively manageable revenue decline, maybe perhaps a margin recovery story via cost cuts and goods disinflation coming out of the post-COVID supply chain squeeze, and a financial policy that would prioritize debt reduction. But over the past couple of years, we've kind of seen most of that get invalidated one way or another. One part is just that there's been a good amount of management turnover, and the company has pivoted to doing more M&A, right? So they spent nearly $2 billion over the past couple of years doing IT Savvy and Lexmark. But more importantly, we've seen just clear underperformance on both the top line and margins from the legacy Xerox printer business. And if you look at the broader credit copy market, the consensus is that it's probably a low single-digit decliner. But if we look at Xerox's top line decline, it's down about 9% year to date, adjusted for acquisitions. And depending on the comps that you're looking at, that's about 5 to 8 points of underperformance versus peers. And this has been a trend over the past couple of years, right? If you look at 2024, you're seeing as much as 14 points of relative underperformance. There's two main drivers there. One, I think that Japanese competitors have clearly been picking up some share over the past couple of years. Part of that is probably due to weaker yen, which is giving them a structural cost advantage. And number two, Xerox has been intentionally pruning some of its lower margin businesses, whether that's paper and supplies, whether that's high-end device manufacturing, et cetera. But it does go to illustrate that Xerox seems to be in a position where it's getting harder to take costs out of the business without exacerbating the top line story. This is a company that has already had a long history of cost-cutting programs. They laid off 15% of their workforce at the beginning of last year and then immediately missed estimates badly over the next couple of quarters. So in general, our sense is that the easy OpEx cuts are already in the rear view, at least for legacy Xerox. And what's left is kind of like this stickier, COGS-related headwind that are going to be much more difficult to cut, especially in an environment where there's trade war and tariff-related impacts. And I think last point on the margin structure for legacy Xerox, I think the operating leverage issue is a bit underappreciated here. We've gone back and done a regression of incremental EBITDA margin to top line decline. And, depending on your look back period, it comes out to be about 25 to 30 basis points for every 1% decline on the top line, right? So in other words, legacy Xerox revenue is down about 9% year to date, and that's cost them about 2.5 points of EBITDA margin, even as they have been proactively cutting costs, right? So that's a bit challenging if we're trying to see them, kind of have an improved margin story against this top line decline backdrop. So that kind of brings us to our forward projections for the next couple of years. We're essentially assuming that classic Xerox is going to see top line declines around 6 points per year. So that's maybe 4 points of relative underperformance versus the market. And then if we layer in a more modestly declining top line stream from Lexmark and high single digit growth from IT Savvy, that gets us to a blended revenue decline of around 4 points per year over the next couple of years. So that still implies an organic EBITDA decline rate of about 20% per year before the cost synergies. Of course, there are opportunities for additional cost synergies from Lexmark. Management is targeting a total of around $300 million over the next 2 years. We're assuming 70% realization, which I think is overall still pretty generous, but factoring in the increased trade war and tariff-related headwinds. The challenge, of course, is that without an improvement in top-line trajectory, the cost cuts from Lexmark are really just going to be a one-time bump. So in our model, we have EBITDA kind of peaking in 2026 before resuming its decline in 27, and then that accelerates. That accelerates to the downside in 2028, right? As far as cash flow generation, the big red flag is that in the near term, the primary generator of free cash flow is not from operations, but from $400 million per year, give or take, of runoff in financing receivables through various receivables sales agreements that Veronica mentioned at the beginning. And we expect this tailwind more or less dissipates as receivables normalize sometime in 2027, right? So we have it going to zero in 2027. It could be a little bit, depending on what the normalized balance of receivables is. It could be 100 million, 200 million more. But in general, we think that tailwind dramatically reduces beyond 2026, which presents a significant challenge to the free cash flow generation story. And then finally, just quickly on, just quickly on the sort of how we arrived to estimating an enterprise valuation for the business. Pure play comps are pretty difficult to find, but if we look at the Japanese print peers and then other legacy hardware names, we're generally coming out to around 4.5 to 5.5 times EBITDA. Lexmark itself, which arguably is better business than legacy Xerox print, was acquired in that ballpark at 4.7 times. And then we looked for other tech companies that are facing steeper declines, right? Like some of the BPO providers, and they're trading more in the 2 to 3x range. So taking all that into consideration, we settled on a base case EBITDA multiple of 4x applied to our projected 2028 EBITDA of $530 million. And that gets us to an implied EV of 2.1 billion mid case. And we would flex that to 1.9 billion at the low case, which is a 3.5x multiple. And then at high case, a 2.4 billion, which is at a 4.5x multiple. I think that will be it. And I'll throw it back to Veronica and see if we have any questions or want to move on to the covenant side of things.
Yeah, thanks, Andy. I just was curious. We mentioned the phase out of that receivables program. So as it does taper off, when does when is that liquidity inflection point for the company?
Yeah, so I really think it's a 2027 story. So back when the company first entered into these receivables sales agreements, they flagged the normalized level of receivables at around 1 billion. So that's what we have in our model. Now, considering the fact that the business has shrunk faster than they anticipated over the past couple of years, we could see that being closer to maybe 900 or 800 million, right? So that's why I mentioned that, maybe that receivables tailwind is not exactly zero in 2027, but I would not expect that to be 400 million either, right? So I think, an incremental 100 or 200 is reasonable. And that's, that's really debatable. But certainly when we get into 2028, I wouldn't anticipate that there would be a meaningful cash tailwind there.
Thanks. And I just want to switch over now to covenant review and bring in Scott. He previewed a little bit earlier, but to talk a little bit more about the secured bonds and some of the covenant.
Sure. Thanks, Veronica. So I've been covering the Xerox bonds for a long time, along with my covenant review colleague, Kevin, who covers the Xerox loans. And we want to take a little bit of time now to discuss the flexibility or lack of flexibility, particularly in the secured bonds and loans. Lots of folks ask us about it, and that's really where our focus has been. So as many folks know, Xerox did first lien and second lien bonds earlier this year in the spring. The marketing started as a sort of regular way high yield deal, but the terms really got tightened up during the marketing of those bonds. Most importantly, a secured debt cap was added to the debt covenants in the first lien and second lien bonds. It's actually very interesting where the secured debt cap got added as one of the changes during marketing and then had to be further changed after pricing because it was drafted in such a confusing way and I think didn't say what folks wanted it to say. So very, very unusual for additional changes to be made after pricing. So this deal was definitely a rare bird. But what we have is a hard rule, an override to the debt covenant that generally says that the company cannot incur any secured debt if the total amount of secured debt outstanding would exceed $2 billion. So that includes the first lien and second lien notes, that includes the term loan, that includes any drawers under the ABL, that would include any junior lien debt that they might want to incur in the future. So under the secured bonds, the $2 billion debt cap is really the key when assessing incremental secured debt capacity under the bonds. As in previous bond issuances, and as Kevin will talk about under the loans as well, there's also a carve out permitting debt up to a 1.5 times first lien leverage ratio. But as I mentioned, the secured debt cap is an override provision. So even if they did have any capacity under the 1.5 times test, it would be subject to the secured debt cap. I want to point out that it's not a secret right and could be changed with majority consent, majority of each tranche of debt it's in. That is to say. Other important considerations in the secured bonds is that there are a number of blockers and a number of secret rights. Both series of secured bonds, the 1L and 2L, include a tight CERTA blocker that requires 100% consent to change or modify the ranking of the notes, as well as separately requiring affected holder consent to subordinate liens. So that should serve to prevent any kind of CERTA-style up-tiering transaction. There's also a vote rigging blocker. In Cora was the prototype LME where vote rigging became important. I suppose it's less important when 100% consent is required to subordinate. But nonetheless, the idea is that the company, if the company requires any changes to allow it to issue additional debt that would be used to influence voting thresholds, that also requires 100% consent. Additionally, the bonds have a double dip blocker in the debt covenant. This one is also a pretty good blocker. Generally says that any debt owed to non-guarantors must be subordinated in right of payment. So typically in the double dip, on the double dip style transaction, the second dip is the intercompany note. So any kind of intercompany would have to be subordinated in right of payment, which really prevents the ability to structure a double dip. That is also a secret right that requires 100% consent to change. Additionally, investments in unrestricted subsidiaries are allowed under only one permitted investment basket for $85 million, or the greater of 10% of LTM EBITDA. And even that basket is limited to customary escrow arrangements related to issuance of debt by the unrestricted sub. So there's really just no room to invest in unrestricted subs in the first place. And then additionally, there are tight limitations on non-guarantor debt incurrence. Of course, any debt incurred by a non-guarantor would be structurally senior to the bonds. And there's a $100 million cap for debt of non-guarantors. So all those working together make the first lien and second lien bonds pretty tight and would be tough to structure around through any kind of LME transaction. And then on the next slide, why don't I throw it over to Kevin to discuss Xerox's term loan.
Sure. The term loan is a little bit different than the secured bonds. They didn't get hit quite as hard during syndications. The protections are a little bit looser. There is no secured debt cap, overall secured debt cap. So secured debt capacity really ends up being tied to the 1.5 times gross first lien leverage test for first lien debt and a 3 times gross secured leverage test for junior lien secured debt. One thing I'd point out is when I say gross, it means they can't net cash from the debt amount in doing the calculations, which is actually pretty conservative for the current market where tests are usually net debt tests. They have some other baskets under the debt and liens covenants, but it's kind of hard to see how they could use those to incur pari passu secured debt. There's a general debt basket that, for one thing, is tied to the 1.5 time gross first lien leverage test to open it up. And two, even if they have that open, they have a general liens basket, I think it's 70 million, but it can't be used to secure debt for borrowed money. So they really couldn't use that basket to secure the general debt basket amount even if it were available. So really it's limited to 1.5 times gross first lien leverage. In terms of junior debt prepayments considerations, in terms of refinancing the unsecured debt, under the junior debt prepayments covenant in the term loan, the 2028 and 2035 notes, they can be prepaid as long as the company had sufficient debt and liens capacity. So they're not subject to the junior debt prepayments covenant. Any other unsecured debt would be. So in that case, they would need capacity under the junior debt prepayments covenant. And the one thing I will say, so they have two baskets that sort of become relevant in terms of dollar capacity. They have a general basket of the greater 300 million and 35% of EBITDA. And then they have the starter amount of the builder basket, which is greater of 250 million, 25% of EBITDA, plus it bills from 50% of consolidated net income. This company doesn't report EBITDA publicly, as I'm sure most of the people on this probably know. So it's kind of difficult to know exactly where their capacity is, but assuming just the dollar amounts or what's available, that gets you to $515 million of capacity on top of the uncapped capacity to prepay the 2028s and the 2035s. In terms of LME protections, it's not as robust as the secured notes. There is a CERTA blocker, but it has an exception that's relatively common in term loans that allows priming debt if the existing lenders are offered a pro rata opportunity to participate in the priming transaction. So there's potentially games they could play with that. It's not as bad as some other ones I've seen where certain fees are accepted. So it's relatively protective. There's a J.Crew blocker that prevents transfers of material intellectual property to unrestricted subsidiaries. I would note that it doesn't prohibit transfers of material intellectual property to non-loan party restricted subsidiaries, which could potentially allow them to engage in some collateral stripping by transferring it down if they have capacity under the investments covenant. And it also doesn't apply to any material assets other than material IP, which is a pretty common flaw of J.Crew blockers in the current market, and it applies here. There's a Chewy blocker that, it puts a little bit of stress on their ability to do a Chewy scenario. There is not really a double dip blocker here. The term loan was shortly after, I think, the first use of the double dip, the first time we saw it. There is a limitation on intercompany debt that if it constitutes an investment, you have to have investments covenant capacity in order to do it. But that doesn't provide a ton of protection against the double dip. So that's a little bit more open than in the secured bonds where there's a pretty strong double dip blocker. And in terms of I'm sure many people are aware they recently did a mandatory prepayment of the Term B loan. At first, we weren't really sure whether it was a mandatory or voluntary prepayment, but we saw some disclosure in some of their presentation materials around earnings that suggested that they viewed it as a mandatory prepayment. And so the asset sale sweep generally applies to only 3 baskets under the asset sale covenant. The general basket, which is the customary 75% cash consideration and fair market value basket, the sale leasebacks basket, and then they have a capped general basket. So if they use any of those baskets, it would be subject to the asset sale sweep. If they use any other basket, it wouldn't be. And there are a couple of baskets that kind of pop out as maybe things they could use to get around it. One, they have this uncapped basket for qualified receivables transactions. And if you read the definition of qualified receivables transaction, it's a little broader. When you think of a qualified receivables transaction, you're thinking they dump some receivables into a bankruptcy remote special purpose vehicle, borrow down there. The definition of qualified receivables transaction in the term loan credit agreement is a lot broader than that. And you could read it to potentially pick up any sale of a receivable if you wanted to take an aggressive rate of it. So it is sort of beyond what you would think of as generally as a receivables transaction. And I guess that, and the other basket, I'm sorry, the other basket that they could potentially use, given to their receivables, they have an uncapped basket for sales of ABL priority collateral, which the receivables may well constitute ABL priority collateral, given that it's a current asset. And so that's potentially another workaround for doing these sales without subjecting the proceeds to the asset sale sweep. And I guess I'll
Thanks,
take
Kevin.
that.
Yeah. Thank you. So I want to get to back to CreditSights. Last week they published a great report on with some cash flow projections through 2029, and they provided some really thorough recovery analysis. So I want to bring Nick and Andy back in on that. They co-authored the report along with head of special sits legal research, Mark Leitner. So Nick, Andy, maybe you can walk us through some of your research there.
Sure. Thank you. Thanks, Veronica. Yeah, so I'll talk through our kind of recovery estimates that we put out last week and also about our recommendations for the structure. So as shown in the image on this slide, we believe that the secured debt in Xerox is covered under a status quo recovery, and that the Holdco notes recover around 22 cents. And, I should note this, not to keep plugging to go read the piece on the site, but, all of our kind of projections and valuation that Andy walked through feed into this recovery conclusion. And we also kind of walk through some other scenarios in that piece as well. So on the recommendation front, as a result of this work, we have a buy rec on the 2L notes, which we view as covered. For the unsecured notes, we definitely have concerns around recovery values, which are generally well below current trading prices for those notes across the board, regardless of the kind of variation of whether they're Holdco or Opco, and their specific guarantor package. So we have a sell rec on the majority of the unsecured notes, but there is one caveat to that, which is the 2028 notes, where we moved from a sell to a hold. We view the notes, those 2028s, as frankly difficult to price, particularly given the cash balance dynamic we've discussed a little on the call so far. That is the significant cash balance we expect the company to build over the next couple of years. And just to reiterate Andy's comments there, because I think it's really important and kind of the key to this story, we've modeled to around $515 million in excess cash on the balance sheet as of year-end 2027. And that's, assuming September 30th balance sheet cash plus the cash generation through the end of 27, less debt maturities, and given an assumed kind of minimum cash balance for the business. So we have that hold rec on those 2028 notes, given we do see the possibility of a path where, there's a real upside there, in an exchange or a tender scenario, as the company kind of works to address that maturity, which, we think is kind of the big issue it initially has to face, at least. And on the next slide, we'll talk about recoveries in this scenario where the company puts this cash to use. So in this slide, given what Kevin and Scott have just talked through with respect to the covenant limitations that Xerox faces, we really think that the way to evaluate the options the company has here, given that the LME playbook is arguably quite limited, is to try and assess how they put that cash balance to best use. As we've just mentioned, the company paid down term loan borrowings recently, and to the extent they continue to use cash to pay down the term loan, it's possible that action would, potentially free up sufficient secured debt capacity to offer an exchange to the 2028 notes or to other unsecured notes. Although we do think, the 28s are obviously the first to mature and the critical issue the company needs to address. And similarly, the company could, in theory, as kind of the guys walked through on RP capacity, could simply choose to tender for those unsecured notes with cash. So we show in this slide pro forma recoveries under the assumption that cash balance that the company will generate is diverted in some manner, right? Either through kind of one of those two scenarios, or there are certainly other scenarios that we could consider. And really the takeaway that we have is, one, the 1L and 2L debt remains covered or very, very close to covered in all of our scenario analysis there. And so, we feel, remain really comfortable with our recommendations on the secureds. And then obviously, you can see unsecured recoveries in that scenario are kind of even more punitive. So really, let's just reiterate the sell rec on the long dated unsecured notes. And I should say, we've certainly had conversations with folks around kind of more aggressive exchange scenarios and kind of concepts that we don't necessarily model for. Probably beyond the scope to really dive into those here, but we're certainly open to getting the team together and having those conversations with folks if clients would like. So that kind of wraps up my prepared remarks here, Veronica. And yeah, I don't know, questions or we can move to Q&A, whatever is next.
Yeah. I on the recovery analysis with the kind of like expected year-end cash of at 2027 of 515 million, are there restrictions on that from that cash to be moved up to the holding company, or could some of it get stuck in foreign subsidiaries?
Sure. I think under the docs, and Kevin and Scott can jump in and correct me if I'm wrong, but generally we should assume that the answer is no, and we certainly assume that in the model. The only caveat is we do assume like that some of that cash does have to be used to kind of continue to operate the business both domestically and in the foreign entities, and the company holds restricted cash now in some circumstances. So, it's not like they can take that cash balance down to zero to address the kind of more complex securities, or the kind of more complex upcoming maturities, the 28s and the 29s. But we do think most of it is kind of fungible and could be used as the company chooses.
Great, thanks. So I would highly encourage everyone to give that piece a read. But with that, we'll open it up for some of the questions the audience submitted and address kind of what came in during the presentation. So one of them, would they have any capacity to issue at any non-guarantors, especially secured debt at foreign subsidiaries?
Under the secured bonds, there are tight limitations on that. There is a tight limit of 100 million of debt that can be incurred at non-guarantor restricted subsidiaries. There is also a limitation of 370 million on the amount that could even be invested into non-guarantors. So the short answer is the bonds would not permit more than 100.
Yeah, under the term loan, they have a basket for debt of non-loan party guarantors, and there's a non-loan party subcap on ratio debt. But all these baskets are tied to the 1.5 times gross first lien leverage test. So if they could meet the 1.5 times test, they could do up to 260 million of debt at non-guarantor. So it's a shared subcap on non-loan party debts. They could do a total of the greater 260 million, 30% of EBITDA. But they'd have to be able to hit that 1.5 times gross first lien leverage test to open up any baskets at non-guarantors.
Awesome. And then another question we have is, in default, how do creditors get paid for debt structured under non-guarantor subsidiaries?
So, generally speaking, a non-guarantor doesn't have a direct obligation to pay. Like the difference between a guarantor and a non-guarantor is the guarantor has created a direct financial obligation to pay the debt. Absent that, essentially you're going to be waiting for it to get returned through the equity of the non-guarantor because you don't have a direct financial obligation. So essentially you're going to be behind pretty much everything at the non-guarantor, and then whatever's left over after everybody. Now, I'm talking even trade creditors potentially get paid. Whatever's left eventually gets distributed up into the guarantor group, at which point it'll be a guarantee and you'll have a claim on it, a direct claim on it. But until then, you're sort of behind everybody at a non-guarantor.
Just to put a finer point on that, this is what we call structural subordination. Debt at the Opco and Holdco levels is structurally subordinated to any debt of the non-guarantor, because like Kevin said, creditors to the non-guarantor have direct claims there, and only after those direct claims are satisfied can any residual equity value flow up the structure to satisfy the debts of the Opco and Holdco.
Okay, I'll jump in with another question. With the $1.2 billion unfunded pension claim, how much influence does PBGC have across the structure? Maybe Nick can hop in on this one.
Sure, I can jump in there. We talked about that a lot in the piece, and our default assumption is that the PBGC has really no input prior to a theoretical Chapter 11 filing, as long as the company continues to maintain its contributions to its unfunded pension plan. That I think a couple of considerations there. One is, if the company were to fail to make the necessary contributions, there is room for the PBGC to file for a statutory lien, which would obviously be like an incredibly negative outcome for secured creditors here, or unsecured creditors here, excuse me, if they were successful in doing that. We model for about a $1.2 billion unfunded pension claim. So, if you imagine that as additional secured debt, that's highly problematic. We don't think that's the default assumption at all. But just as far as kind of process, it's important to note that, I think. And then, in a theoretical filing, I think the PBGC has a lot of input, because that claim is substantial and generally, we believe would be pari with at least pari with unsecured claimants with guarantors, and similarly kind of senior on a control group basis to perhaps the Opco bonds without those guarantees. So yeah, no immediate influence, but definitely a big consideration here as we kind of watch how things evolve.
Thanks, Nick. And there was a question on the mechanics of the term loan pay down. I believe it was in October. I believe the company addressed that in their most recent presentation. One of you wants to speak to that. I believe they classified it as finance receivable sales proceeds.
That's correct. I think Kevin, the presentation, the earnings presentation for September 30th specified that it was a mandatory pay down with the proceeds from a sale of receivables. I think Kevin kind of touched on some of the nuances there. It's without knowing a little bit more about the specifics of that receivable sale, it's hard to really, get, I think, too speculative around kind of how other sales could be treated or other sales of receivables might be treated. But certainly something we're considering and happy to talk to folks offline about as well. Kevin, Scott, I don't know if you guys want to add anything on that.
Yeah, the one other thing, just in terms of mechanics, one thing I would point out is that under the term loan B credit agreement, they don't have reinvestment rights, which is unusual in the current market. Normally, you see some kind of a period where they can reinvest the proceeds rather than making the pay down. The term loan credit agreement does not have that. So once they determine that they have a transaction that's subject to the asset sales sweep, they have, I believe, it's 10 business days to make the payment. So they don't have this, year-long reinvestment right period. And the other thing I would note is that there is a de minimis threshold in the asset sales sweep that is, it's per transaction rather than per annum. So they can do, a bunch of small transactions and kind of leak value out. And it's greater 85 million, 10% of EBITDA, and then only amounts in excess of that threshold need to be applied to the asset sale sweep. So there are a couple of ways they could potentially, even if they determine that it fits into one of these baskets, that they may be able to not prepay the term loans. Obviously, in this case, they decided that they had to. And so I'm not sure if they applied their threshold amount or not. But they ended up with whatever the number was, 40 million, I think. And so that they determined that was required to prepay the term loan, at least according to some of the materials that we saw.
Nice. And then last question here before we wrap up. Do you think there is a strategy here for the unsecured bonds to take the equity via Chapter 11?
I can jump in on that one. Though I think it's obviously a tough, a speculative question. I think where Andy and I come out on valuation and recoveries suggests that is a little bit of an uphill road, honestly. If you imagine the company going through a hard restructuring on a pro forma basis, that exit capital structure probably looks over levered if you leave the 1L and 2L in place. So I think arguably if we tried to think about a Chapter 11 plan today where the unsecureds took control, they would have to write enough of a check maybe to take out that 2L piece, and whether they want to do that obviously depends on the views of kind of valuation of the business coming out of such an event. So it's certainly possible, and there's certainly a strategy here. And I think if people are maybe slightly more bullish on the fundamentals and valuation than we are, then that strategy can make a lot of sense. But I think there are kind of puts and takes as well around the pension how the pension might be treated in that scenario, and other considerations there, as well as if the company, if the company entered with a significant cash balance and didn't need, substantial financing through a process, versus if it, had already paid down that cash balance in some way. So, hopefully along the way from that becoming a reality. But I think we could see it go both ways depending on how bullish you are on the valuation. Andy, I don't know if you have anything to add on that one, on a end of webinar speculative basis.
No, I think you covered it. I think there's, I feel like it's possible that we're kind of on the conservative side with respect to our kind of revenue decline projections and EBITDA projections, but I think we're pretty generous on the synergies realization and also the multiple. So, I'm comfortable with our kind of base case.
Thanks, guys. I think with that, we're just about out of time. So thanks again to our panelists and to everyone who joined us today. We'll be posting a replay of this webinar on the CreditSights YouTube channel, and we'll also send over a link to anyone who registered and attended. The slides that were sort of on the screen throughout the presentation will also be made available. So with that, hope everyone has a great rest of their day, and thanks again for joining us today.